What's up, YouTube? It's Joe Catchpollia sitting on the couch, making some money investing in fractional real estate online, as usual. Today, I was talking to a new fractional real estate investor, trying to work through some of the different options as far as for somebody who is looking for some real estate exposure, looking for relatively steady returns, and doesn't want to do just a ton of due diligence on every single deal, doesn't want to live in the Discord, doesn't want to do a lot of the stuff that I think is necessary if you're going to be on some of the platforms. And it brought me back to talking about Groundfloor a little bit. Now, if you've been watching my channel for a while, you know, a year ago, somewhere around a year ago, this was really my favorite platform. You can see, you know, I got started right around a year ago, and I was adding money, and then I just let it ride for a little bit. You know, I was doing perfectly fine, and they did this thing where they paid off a whole bunch of loans at once, and there wasn't anything new to invest in. It was pretty frustrating because it took me a while to build this diversified portfolio, and then they just sort of artificially paid it off to move those borrowers to some other product. That's been 4 or 5 months. Since then, I have finally been able to get, pretty good diversification back, crossed over 100 loans, hoping to get more. No indication that this is going to be something that's repeated, although we'll have to see. But it's over time, I'm starting to think, well, maybe this is actually a pretty good option when we think about it compared to everything else, right? It's not as if I lost money on those. I ended up with just a bunch of cash sitting there, with nothing to put it into. And so I had to take some off the platform. I could have let it sit there, and then probably by now there would have been plenty of opportunities if I were putting a little bit more into each loan. But it really just made me a little bit gun shy, right? Because if I develop a really large portfolio on here and then something similar happens, I could just be sitting on a ton of cash at a time where it might not make sense to be. Putting that risk aside, which I think is a real risk, but I think it's when you compare it like to the risk of buying into a property on Lofty and somebody was allowed to move the title to into somebody else's name, right, where the DAO no longer owns it, or on another platform like Landa where they just shut down everything for like practically a year. Like when you compare it to some of the other risks out there, I got my money paid back early, and so I missed out on some return, like boohoo, right? It's not the end of the world. They're still the platform with the longest track record out of everybody. And so they have done a revamp, and I wanted to just go in, share a little bit about my portfolio, show you how the auto investor works now, because I did a video on the auto investor, but it's now useless because it's, the user interface has changed. And then, that's really about it. I also want to just mention, so a lot of stuff is just not as obvious as it used to be. I feel like, I don't know if it's just because I'm old and I don't like change, but I find it much less intuitive to navigate my way around here, unless they just don't want me, looking where I want to look, right? So none of these are useful to me. At least not now. If you click the invest tab, you can look at the new stuff that's available. But if I want to look at what I have, I click into my investor account. This is where my LROs are. This is what I invest in on here, right? I'm not investing in the flywheel portfolio. I'm just buying individual LROs. You can see this is when I just took money off the platform. This doesn't represent any sort of loss. Of the loans that I've had that have gone full cycle, my average rate of return has been 11.5%. We've discussed a little bit how that average is like just a simple average. It's not like dealing with, the over time, like which one, if you had something outstanding for twice as long, it doesn't count for twice as much. But it's still, it's pretty close to reflecting the return I've actually earned on invested capital in here for ones that have paid off, right? And then I have a lot of loans that are still open. So right now, I've got 101 loans. 100 of them are performing. One is in what they call extended. They're not in default yet. I couldn't find a for sale listing for it, and the notes when you go into, whenever you have an extended one or any of them, you can click on it. You can click on the property itself. You can read the updates. Okay, they're pursuing a refinance loan, so that would kind of explain why it's not listed right now. If they're going to refinance it and try to hold it, makes perfect sense. I don't know. I didn't go back and look like did they have a listing that was up and that came back down. I'm not sure. I don't spend a whole lot of time looking at these because every single one of them I don't have a ton of money in any of them, right? My goal on this platform has just been very wide diversification, which is why it was so frustrating when I went from 120 loans to having 70 of those pay off in 2 days. Normally they're rolling over pretty regularly. But so to just have that extended, it's not even in default. I've had really good luck. Some of the people that have been on this platform longer than me have mentioned that they just have a ton of defaults. I'm not sure why. I've bought pretty much everything that comes on here, so it's not like I'm doing a good job selecting them. I just, I think this has just been a good time period to be an investor on this platform, and maybe some of the people that have had much worse returns, they got started at, maybe the worst possible time or something. So they ended up with a lot more defaults. I could imagine that because if you think about a few years ago, if some of the loans that were made during the peak of the boom, I could imagine a lot of those went bad. So it makes some sense. Anyway, because, and you can see my closed projects. I've had 100 and I don't know why they don't do a total on this page. So 153 closed. 21 of those were extended. A lot of these extended ones that paid off, some of them actually were just a natural payoff. A lot of these were included in that bulk payoff that just got moved to a different product. So I don't know if that was intentional. I'm really not sure why that happened, but we didn't really get a whole lot of detail from the company. In any case, all these paid off, and you can see, with a relatively good average rate, right? This is a first lien loan product. It is for fix and flip or new construction. So, there's some risk there, but I think that, a double digit return on a lending product is pretty fantastic, especially if you compare it to like, some of the other private credit funds that are out there, right? Like if you look at Arrive's private credit fund, or Landa did start one, but I think they only ever had a couple of loans in it. Your returns that you're seeing on this debt it's just higher, right? And now those are different types of loans, and so maybe the risk profile is a little bit different. But they seem to be doing, at least in the short, the year that I've been doing this, it's worked out really well. Now, obviously, I'm not putting a ton of my net worth in this yet. I've been, you can tell from the way I'm talking about this, I've been really slow and, sort of methodical about, okay, I was adding some, got to a certain point where where I had enough where my payoffs were letting me buy some of every single one that came up. Then had this little incident, but now again, I'm starting to get to a point where I'll probably add a little bit more money because I am not, my auto investor isn't picking up every single one anymore, because I'm not getting enough payoffs, right? There's not, so there's more investment opportunity than I have the capital on here for, basically. But so, okay, I've mentioned the auto investor a few times. How does that work now? You think, okay, maybe you click on invest, and maybe you can find it from there, but I can't find it from there. I always click on this little guy here. Oh, is my picture going to get in the way of that? Let me move that. So you click on this little guy, and then you click on auto investing. And then this looks a whole lot like it looked before, right? When we had the auto investor tab in the old user interface. I don't really understand where they're getting these return numbers from. They don't seem to match up with like the interest rates that we see. I don't know. I'm curious if this is their actual historic data on these. But basically all you do in here is you put, okay, so whenever money hits the account, because I have a payoff or I send money in, what the auto investor will do or automatic investing will do, I guess that's what it's really called, right? What is it called? Auto investing. What this thing will do is whatever money you put in each one of these categories, it will, if there's a loan, like, so for example, okay, it goes down the list. There's a loan. The loan's A, it's rated A. These are the ratings that Groundfloor gives it. Okay, it'll put $50 into any of those that are available. It'll do the same thing for any of the B loans that are available. So until all of my money is used up, right? And so you've seen this if you've been watching when I do, my updates each week. Like, okay, this was an auto investor transaction. I had a payoff. It was $120. It put $50 in the first one, $50 in the next one. There was only $20 left. It put it in the, in the third one. I believe, I actually don't, and then I think what actually happened this day is then there was another payoff and another $50 went in. But whatever the last one is, it's just going to get, rounded to the nearest $10, whatever is left in there. And that's all you do down the line, right? Now, I've seen some people try to adjust this where they're saying, okay, I want to invest larger amounts of money in the more secure loans, smaller amounts of money in the less secure, more risky ones. I've decided not to do that. One, I'm just trying to get the widest diversification. And so if I'm doing that, I want it to be somewhat balanced. Now, one of the things that I've noticed is they have a lot more of certain loans than others, certain grades. And so I'm not really getting balance across all the loan types. But I don't necessarily think I need that. I think I need the most, just the largest actual number of loans. So, because they're getting geographic diversification, you're getting diversification of the borrowers, you're getting, timing wise and everything like that. Right. So one of the reasons I'm not too concerned about what their letter grade is that they are doing a risk assessment of that letter grade and changing the pricing on those loans accordingly, right? That's why you see when we have, higher graded loans, you've got let's see. I hate the way this looks now. This is another reason that I'm just really using the auto investor is because I don't like, I can do the list view. Okay, I can do this at least. Loans, and then are the loans the same as the LROs? I don't even buy it with this, right? Yeah, this is the same thing. But so, okay, you've got a D, you've got 13.5%. You've got a C, you've got 11%. They have a lot of C's. Most of my portfolio has been C's, right? You've got a B, okay, it's 10%. So they're already adjusting the pricing. They're giving better pricing to the lower risk. And so it's in essence, you're basically getting paid for the higher risk loans when you lend to the higher risk borrowers or on the higher risk deals. And so in theory, if they're doing a good job of that, then there's no real benefit to pick one class over another, right? I mean, some of them will have more defaults, but you'll be getting paid enough for the, with the extra interest rate to make it worth it. Like that's the theory there, right? With the changing interest rates. Does that hold up over the long run? I don't know yet, right? That's why it's one of the reasons that I just want to get put the same amount in every single one that I'm buying and just buy lots and lots of them, because over time I start to get some data on, okay, how does the borrower experience number, right? This is one of the things they give us. How is that going to affect my returns? Yeah. And these are relatively small sample right now, but I've only been doing this for a year, right? I think over time I'll be able to get good at figuring out, are there some opportunities to do a little bit better than the average? Now, my guess is the people at Groundfloor, whenever I hear them talk, they seem to be, pretty rational finance type people, and they understand this stuff too. So my guess is they're really looking at this data, and that's what's impacting their pricing, right? The amount that they'll lend, or the interest rate that they'll lend at. And so My guess is there's going to be very little opportunity to outperform from, by picking individual ones. But I don't necessarily know that's a fact, right? I mean, they're a company that makes money by lending out money. If there's demand in some markets that are a little bit riskier and there's only demand at a certain price, are they going to lend it where they make their money on the points? It's tough to know, right? I mean, maybe the answer is yes, and maybe I should be being a lot more selective. If you haven't watched any of my other videos about Groundfloor, the reason I'm doing these so much differently than, like, for example, when I invest in a property on Mogul, I spend an hour doing due diligence on that property, doing a due diligence video, and really I'm spending a lot more time digging into those properties than that. But those are properties I plan to hold for 5 to 7 to 10 years. These are all short-term notes, right? So if I was doing a lot of due diligence on each one, I'd never get to a portfolio of hundreds of loans, so I wouldn't get that type of diversification. And two, it'd be just a lot of work for a short time period, and then I'd have to do it again. Which reminds me, I forgot to say earlier, please like and subscribe. In the description to this video, I have links to all the places where I'm currently investing in fractional real estate online. Please do your own due diligence on all of those platforms before investing. I do have some of them are referral links, and you'll get some where you might get some money for signing up. But don't just do that and not I want you to actually dig into each of those platforms yourself, dig into the properties. Just because I invest in something doesn't mean it's a good idea for you to, right? I'm sure we're at different stages of our life. We have different risk preference or risk tolerance, different time preference as far as like when we need that money back. So you want to really dig into each one of those on your own. Don't just do, don't like the strategy I'm doing on here might not be the right strategy for you. There's someone in our Discord. Oh yeah, in the description of this video, there's also a link set up to the Fractional Real Estate Investors Discord. It's just a generic Discord that I set up where we talk about any of the platforms: Mogul, Groundfloor, Lofty, Arrived, Landa, if there's still people talking about it, Saul's Lot, Collab, any of them. There's, we've got separate channels and you can, have a discussion. But yeah, there's somebody in our Discord that comes and talks about, like, he is doing serious due diligence on individual loans and being very selective in the properties that he picks. And he's just putting more capital to work in individual loans. I think it's a perfectly reasonable strategy, right? It is the opposite of what I'm doing. Mine is, if you could compare it more to like just doing an ETF, right? I'm just trying to do, or an index, right? I'm just trying to do the whole index, all the loans, and get the market rate return. And he's trying to, pick very specific ones and using some of his real estate knowledge and insight to do a little bit better, which is what I'm doing on most platforms. It's really the short-term nature of these loans. That's why I'm not doing that here. But yeah, so I think that there's opportunities to go either way, and this is how I'm using it. So yeah, I just wanted to point out, if you want to use it in the same way, you just have to use this auto investing tab. The other thing, they used to always have where you could find your referral link up here, and that took me a little while to realize, oh, that's down here, right? And so if you're going to be referring people, obviously, if they invest, I think, yeah, once they invest $100, then you get 50. You each get 50, right? I did this when I signed up. Other people I know in our Discord have done this as well. Yeah, you just have to find it down here now. It just looks like a little present. I don't know why they moved it from up here. It honestly, it took me way too long to figure out where it was. I clicked all these other buttons first. Again, maybe I'm just the old guy that hates it when that doesn't like change. I think that that's possible. What else is, they are still, like, this is, they are still, in my mind, really trying to get you to do this flywheel portfolio, which is my least favorite thing that they're doing, right? Like, if I wanted to invest in a REIT, I would just invest in a public mortgage REIT. Like, okay, maybe at the moment they're giving you a little bit better yield, but honestly, I'm not sure that that's true, right? If you look at, I haven't really been up on the mortgage REITs lately, so maybe some of them aren't doing as well as they used to. But I think as soon as you start to do this, you get like, you can actually look at what's in this, in that portfolio. Where is it? Yeah, you can look at the assets, right? And so you start to understand everything in there. And I guess, I'm kind of, in a way, I'm doing this, right? But you notice they have much different amounts. They're not evenly spread across all of these, right? And so at the moment, it doesn't look like there's a huge concentration in any one. But at some other points in time, you did have just gigantic, a ton of concentration in just a few of the loans. Well, and I guess you have some here as well. So I feel like I'm able to get a better, even if I have less loans by doing the strategy I'm doing, I feel like I'm getting a broader diversification where I have less concentration risk to any individual loan. And they're charging a fee for this, right? Like if at some point in time they charge a fee to use the auto investing, that might change my mind about it, right? But for now, this is where I'm sticking with. Clicking right there, clicking auto investing. Once I add some more money to the platform, I'll probably start to bump this up. But again, I've been going slow because they really broke my trust in them at this little event here. But like I said in the beginning, in the grand scheme of things, this is not nearly as bad as a lot of what's happened on other platforms. And I guess that's maybe not the way you want to pick an investment platform. And it really, I guess, is not. But it's overall, I'm still doing very well on here. I just had to take that cash off and put it somewhere else. So I don't know. I mean, obviously it's something you have to make your own decision about if you think it makes sense to you, or if not. And that's really it for me for today. If you're using Groundfloor regularly and you haven't joined our Discord, like I said, there's a couple of people in there that talk about it pretty regularly. One guy in particular that really shares his insights about the individual LROs he's picking. Actually, I really appreciate the thoughts that he has on it, and it has started to make me wonder, should I start to, trim my portfolio yet? But at the moment, I'm sticking with what I'm doing. Over time, though, I do think I will make some changes based on how that performs. Yeah, but that's it. Yeah, but if not, jump in there, share what you're doing. If you've been on here longer, and you are somebody that has, a lot of defaults in your portfolio, I'd be interested to hear that too. Were they mostly in a certain in a loan classification, like letter grade? Were they the lower ones? Was it across the board? Yeah, and that's really it for me for today. So until next time, I'm going to just keep making mistakes so that you don't have to.